Okay, well, I have us at the hour. So for those of you that have joined already, welcome. And those of you that are joining along the way, we welcome you as well. My name is David Harvey, Country Head of Sales at Saxo Australia. And I'm joined today with a mutual client of ours, a long-standing client of Saxo Australia, but also a bit of a household name when it comes to the Waterhouse family, Tom Waterhouse. So Tom, thank you so much for coming along.
Thanks, David.
Great. As you know, and I guess for the audience that are clients and for the audience that are not clients, who are Saxo? So Saxo is a global platform, as I said, all over the globe, but here in Australia specifically, we provide access to global markets. And today we have an example of how one can express an investment methodology, a way of diving into some of the great minds when it comes to funds management, and then seeking to put an overlay over that, I guess, implementation of a portfolio. And at Saxo, we're the perfect place to be able to execute against such a strategy across the globe. I'm thrilled to be joined by Tom Waterhouse. So for those of you who don't know, obviously the Waterhouse family has a steeped history in Australia. Most of you would know of that family. But what I didn't know, and I've discovered in the last number of years through Tom's, I guess, various iterations through his career, is now landed at Waterhouse VC. And Waterhouse VC, I guess, is from bookmaker to venture capitalist, if I was to sort of encapsulate that in a sentence, which is quite a journey and fascinating in and of itself. And maybe we can discuss that at another point. But today we're here to talk about a data-driven equities strategy that's been quietly outperforming the market, which is absolutely fascinating. Now, this conversation is especially relevant for investors looking to build a methodology-based investment strategy. And I think oftentimes we get asked, Tom, how does one invest and where do you start? And our first answer to that is to have an investment philosophy or a strategy. That's the most important part. So we'll be unpacking that today. We'll be tapping into how Tom and the team dive in or dip into, I guess, the methodology of some of those top investment managers around the world. And as I said, implement their own overlay. And then finally, we'll round that off with how you may be able to implement such a portfolio approach on the Saxo platform. So that's quite a mouthful. Maybe we'll go back a little bit, Tom, and just start with, I guess, the beginnings of your journey and what led you to where you are today in terms of having both the VC fund and the 13F fund.
Yeah, okay. Thanks, David. Thanks for having me on. As you mentioned, the family's been in gambling for over 100 plus years. My great-grandfather was a bookie, and I thought I was always destined to be a bookmaker straight out of university. But then there was a technology change with iPhone and 3G internet and the change in advertising restrictions. So launched an online betting business, tomwaterhouse.com, sold it to William Hill, ran William Hill's business for 4 years. And then we sold that in 2018 in part of the PokerStars, Flutter, CrownBet merger. I had a 2-year non-compete and realized in the trillion-dollar gambling industry, actually the margin had gone from the operators, which traditionally made most of the money, to the suppliers. So started Waterhouse VC in 2019. And really with the focus to invest in the supply side. So rather than investing in Tabcorp or Ladbrokes or Sportsbet, we were going to focus on the technology that powers those companies. So for instance, many of them use OpenBet, a platform business for their technology platform. Many of them use Sports Radar or Genius Sports for their odds on English Premier League or basketball. They use Racing and Sports or BetMakers for their data on horse racing. So there's these third-party suppliers that connect into the ecosystem. And so we said, well, we're going to focus on this. And then we came across, with our first deal, we put some equity into the deal, but we got an option to be able to acquire 19.9% of the business at an agreed strike price for 3 years. And that deal did very well for us. And so we thought, well, actually, we're going to adapt our strategy and we're going to just focus on buying options in these technology suppliers. And that's been very successful for us. We've got a team of 10 and we go around the world to every gambling conference around the world and look at all the suppliers and basically try and pick what are going to be the future suppliers for Hong Kong Jockey Club, Tabcorp, Caesars, MGM, and so on. And rather than putting equity in, we acquire an option. And the fund's been going nearly 6 years, and it's gone really well. And we've got a good following of investors, and they've put money with us, but it's not capital intensive buying options. And so we thought, well, halfway into the journey, we went, well, actually, we need to deploy this capital rather than sitting in cash for our investors. What should we be doing? And that sort of took us down this path of being an equity investor alongside being a gambling tech investor.
Got it. Fantastic. So I think if I was to summarize that, it was about really diving into, I guess, generations of knowledge, seeing the advent of online, getting ahead of that. But now also, as the industry is changing or has changed, really looking to those suppliers and leveraging into that, hence the VC fund.
Yeah.
But I think I've largely got my head around that, because I've obviously heard this a number of occasions. But what I also find fascinating, as you said, is the deployment of, I guess, the funds that sit alongside that, the investor money within the 13F fund. So just starting there, why a 13F fund? Why did you go down that route, Tom?
So we've got limited capacity in our fund, but we want the fund to be, rather than just a family fund, to have it open, because it opens our network, it opens to new ideas, and we basically have, it's only a small wholesale fund, but it has sort of 90 investors that are going on the journey with us. As I said, we can't deploy all of the money into option deals because we're buying the options. So we went to our investors and said, look, currently the money's in term deposits, sitting in cash. Do we buy bonds? Do we put it into gold? What do we do? And the family, for over the last decade, has deployed a 13F strategy. So one of my very good friends worked for 0.72 Capital in Magellan, and he used to complain that they had to release a 13F filing. They did all this hard work, and they'd release any fund over 100 million in US equities, had to release a 13F filing 45 days after the quarter. And so over a decade ago, we started following the best performing long only funds and said, well, look, they released the 13F filing. They've got an average hold time of over 7 years. Why don't we just see what they're buying and then try and follow their top positions? And so we've had good success as a family doing that. And I went to our investors a few years back and said, look, the fund's sitting in cash. We spend all our time focusing on finding options in these technology suppliers, but we don't want your money sitting in cash. We'd like to deploy it in this 13F strategy. And so what we do with the strategy is we follow the 16 best performing long only funds. We go through their 13F filing once a quarter. We then apply 4 screens. So it has to be over 1% of their portfolio, has to be trading at under 20 times PE, has to be growing revenue greater than its PE, and it has to have very little debt. And so we look at those 13F filings. It normally comes to around 10 to 20 positions. And then we send to Saxo and say, look, we'd like to evenly weight into these positions every quarter. We send to our investors who want it. We say, look, this is where the money's deployed. And now we're going to keep focusing on option deals. And what we try and say to our investors is your money is working for you in these stocks.
Underlined.
But we're going to spend all our time, rather than trying to focus on picking out the best equities, we're following the best funds and their selections in equities. And we're going to focus all our time and effort in the area we know best, which is finding technology suppliers in the gambling industry. And we say to our investors, look, if you keep seeing quality deal flow of options coming through to us, then we're going to be likely going to be a high performing fund. Because worst case scenario, we're this US equity fund, but hopefully these options will come off over time. If you don't see the options coming off or coming through all the time, then probably this fund, we're just a US equity fund. You can probably do that yourself on the Saxo platform or some other platform. And so our investors like it because they know where their money sits, but at the same time, they see us working really hard to find quality technology suppliers.
Got it. And I can see some slides rolling through, and thank you for that. I guess maybe taking a little bit of a step back, there was a lot there, Tom. 13F, for those of you, for those sort of listeners or watchers that sort of don't know what that is, can you unpack that, please?
Yeah, so after the global financial crisis, they changed that any fund with over 100 million of US equities had to release a 13F filing within 45 days of the quarter end. So there's a time lag. Obviously, some funds are like hedging their positions, shorting their positions. What we go, well, we know where there's a time lag, but we want to be in the funds that have a very long average hold time. So 7+ years average hold time. And we want to follow those funds. And try and find their best positions that we still believe are value, and so we have a systematic approach. We don't put any personal input into it. If they choose to be in Westco or Dick's Sporting Goods, we've got no opinion of the stock. We follow a formula that we're just very clear with our investors what we're doing, and go that over a long period, we believe that these best performing funds going to value US equities is a nice place to park money while we try and find the real upside through the options.
Yeah. So, and the 13F lives on the SEC, which is the exchange sort of, I guess, commission, almost like the ASX, but the version of that in the US, right? So we got that bit. And then I guess the second part is, okay, I'm looking at the 13Fs and I'm having a peek under the hood, and having a look at those holdings every quarter. But then I guess there's another choice, and that is the managers themselves. So how do you manage the managers, Tom? How do you A, pick them, and B, fire them, I guess?
So we basically follow a report. LCH puts out a report every year of the best performing long-only funds, and we let them do the work on analysing which are the best long-only funds. And then we just follow those funds. So we don't have any personal opinion whether we should be following, I don't know, like
Berkshire Hathaway
or Berkshire Hathaway or any of those funds. We just follow what they say are the funds to follow, and then we follow the positions that those funds using those 4 criteria. So we want to make sure we use 2 growth factors, so the average growth rate over the last 5 years and the compound growth rate. So we don't want that they've suddenly had some spike in performance. We want that they're trading value, so under 20 times PE, but they're still growing revenues at a greater percentage. And we want that they've got very little debt, because obviously interest rates might go up, and we want to make sure they're high conviction positions for these funds. They're over 1% of their portfolio. And we just basically do that, have 2 analysts do that once a quarter, and then give it to you guys and evenly weight into those positions. And then just say to our investors, look, that's where the funds are. And hopefully we find great long-term investments in these options that we're doing.
In the meantime, and that's where we can focus. Sure. So am I right, therefore, in saying that a manager would be only hired or fired annually? Is that the way to think about it?
Yes.
And then the rebalance would happen quarterly?
Rebalance happens quarterly, So we, any new money into the fund, we deploy. So it can actually be within the quarter. If we get significant new inflow, we send it to you and evenly weight into those positions. And then we actively, once a quarter, sell the positions that are no longer meet the 13F criteria, that are a loss-making position. And we evenly weight into the new positions with the money that we've got.
Got it. Just on cutting losses, we might get to that a little bit later, but I'm already hearing messages. I think one message I'm hearing is being dispassionate. So being passionate about the outcome, but I guess not, having no personal preference around some of these choices. Is that an accurate representation?
Look, it's very narrow what we're good at. We're really good at one industry and one little segment of that industry. And we don't pretend that we're anything else. But at the same time, we know that there's very good investors out there. Most investors find it hard to beat the S&P, the index. But there are a few investors that are good and really good, and we just want to basically follow them, be long-term holders, and let them that compound away. But at the same time, really focus on what our edge is.
Got it. And I'll might come back to this at the end around who this sort of a strategy might suit around wholesale and so on. So we might come back to that. I notice on the screen there we have the investment filters, which I'll come to in a moment. Actually, let's hold that thought. But before we get there, risk. So if we think about risk and return, obviously, we saw the slide before when we're beating the S&P 500 with the 13F fund. How is it that you guys, or the, I guess your approach takes into account risk, takes into account Sharpe ratio, takes into account, is it just growth you're looking at, Tom, or is there a filter for risk as well?
So we actually didn't really set out to necessarily beat the S&P. We just want to be more conservative. So we basically want to say to our investors, look, the money's actively working, but we think we'll outperform in worse times than in good times. So we have that value filter, trading under 20 times PE. We really just want to be a conservative group of stocks. That cuts out a lot of the high growth tech companies.
So there's no Nvidias in your, I'm guessing.
Not that we have an opinion to that company, but they don't meet our criteria.
Right.
But so we basically just want to be in large, steady, great performing businesses these best funds are in.
So there's Walmarts and Dick's Sporting Goods.
Dick's Sporting Goods and Westco and
Bank of America.
Bank of America, these sort of things. So, and yeah, we just park the money there and basically follow the formula, you know, and don't get carried away with earnings results or thinking anything about any particular company. We just go, well, look, we want to park the money in these positions. We have two major risks as a fund. Obviously, 70% of the revenue of those companies is US dollar denominated, so it's US currency risk, and we've got US equities risk. You know, so like if you're not happy being in the US equity market, then there's significant downside in the fund if you're not happy with that. But if you're comfortable with US currency risk and US equity risk, we think we've got a conservative, more conservative than the S&P way to follow these best fund managers. Now that doesn't, it's worked well for us historically as a family, and in the fund it's worked well, but the next 10 years, we think it's a good strategy, but you just never know, do you?
Yeah. Well, I guess you've proven to date you've been agile in your thinking around what that might look like. So
and really our focus is we want the money to work for us, and we want to really focus on finding very high quality option deals, and that's really where the value in the fund is.
Yeah, got it. Okay. And again, we'll come back at the end as if anybody who's watching this or listening is interested in that options deal scenario, we'll talk about that at the end. Tom, I guess a couple of things I heard there, currency risk, you know, and you and I have spoken about that in the past, about how your investors look at that and have a lens on that. But maybe for the benefit of those listening today, you know, they have a US equities portfolio or even a sterling or a euro, you know, they have another currency, but and there's ways to mitigate and obviously hedge, you know, against that as we've discussed, you and I have discussed, but why is it that effectively you're unhedged? What's the thinking there?
So we really appreciate you and your team, all the work you guys did into the hedging, and we just went to our largest investors and said, look, this is what hedging looks like. This is the cost. We are going to have different price points. We're coming into the currency all the time because it inflows into the fund. And we're looking at it over a 10, 20-year view. And their view and our view was, look, there is definitely benefits to hedging, but for us, with that long-term view, we'd rather not wear the cost and happy to expose a portion of what we've invested into this fund to have that currency risk. So happy to be exposed to the US dollar and exposed to US equities, but realize that it's not as smooth as if you hedge. But at the same time, over a 20-year period, the benefit you have of not having the hedging cost.
Yeah, and I guess the other part is the inflows. You know, and that might be, we're jumping ahead a little bit to some of the lessons for investors, but I think rather than sort of plonk, you know, an AUM or a large check is written from Aussie dollar to US and that currency risk is born at that point. Really, I guess what I'm hearing is there's a smoothing of that.
That's right. Some months it's 69 cents, 65 cents, 61 cents, and
you're almost dollar cost averaging, aren't you? You know, both into the market, but also into currency. I find that fascinating. Just maybe switching back to the screeners, you know, and just spending a little bit of time, I think, please, on those, Tom. So if we could unpack those screeners and double click, please.
Yeah, look, so in terms of, we just thought that trading under 20 times PD, like long-term average might be 15, 16 times. We didn't want to be like block out any high PE companies, but we sort of thought, well, if we're 20 times and they're still growing revenues greater than that, that was sort of a point that we were comfortable with. We did a lot of back testing with a couple of our investors on what these criteria should be. And then we wanted businesses, even though they were low PE, we didn't want to be in the ones that were like what was one about the cigarette butts. We didn't want to be in the ones that were ultra cheap, but not high growth. So then we went in and said, well, look, we need to find businesses that are still growing revenues at a greater percentage than their PE, but we don't want to have it where they've had a one-off spike. So we need to smooth that out. And then what we thought about this strategy is during the interest rate increase cycle. And so we were like, we need to make sure that we don't know if interest rates are going to stop at 4% or 5% or could be 10%. And we just want to make sure that we're ultra protected, that these companies can meet their debt obligations. And so then we put the debt filter in, and then we just wanted to make sure that we were in, which was high conviction from the fund's point of view, that we're picking the stocks that they've actually putting a lot of money to work in. And 1% sounds small, but it's actually a hell of a lot of money for these big funds that they're putting into it. So and that's our fourth filter.
Cheeky question, have you ever thought about changing those filters? You know, how is it, I guess, as an overarching methodology that you would sit back as a group and say, okay, is it time to, I guess, back test, retest, rethink?
Yeah, look,
based on all that's going on, I guess, in the globe and also markets.
We're constantly challenged in that we've been lucky enough to have a few of the big, large betting syndicates that invest with us, and they're constantly pushing us. Have you thought about this? Back test this, try this. We're very open to it. We're very open to just parking the money in the S&P. You know, it's not like this isn't some, like all your investors, they could adopt this strategy. You know, like we've used a few third-party tools to make it easy for our analysts to do it, but it's not like we've come up with, it's not rocket science what we've come up with.
Yeah.
We just want to basically be very clear with our investors where their money is and why it's there. And so, yeah, we're very open to look, but we don't want to do it ad hoc. We're not trying to reinvent the wheel. We basically say, look, this is what we're following. This is where it's parked. This is why we think it's good. We're going to keep back testing every quarter. But really all our time and effort is spent on the option side.
Play. Okay. We might spend a little bit of time, if you like, on the option play. You know, why don't we spend, even though it's outside, I guess, the remit of the 13F fund and not normally available to, I guess, a retail investor and also, you know, only a wholesale investor. But would you like to unpack that a little bit more, Tom?
Yeah. So look, we realised that because of the increasing in regulation, both taxation and advertising restrictions, that these companies were differentiating less so on above-the-line marketing and more so on product innovation. So you've probably seen the large bookmakers, they've got cash out and bet with mates and vision on this and odds on 150 different scenarios. And they've really differentiated on that customer experience. And a lot of that customer experience is built internally, but a lot of it's built externally. And so our vision was, well, we're going to be long-term investors in that tech layer of the ecosystem. And so we go to, team myself, go to all the conferences around the world. So I was in Fort Lauderdale last week. Oscar's in our team was in Malta the week before. We've been in Rio, in New York, in Barcelona, wherever there's a conference. And these conferences are not some small conference. They're 50,000 plus people with all different suppliers from all over the world coming. And we basically go and try and find what we think is very scalable. So it might be a business that's an esport data supplier in Eastern Europe. And we go, actually, that business could work really well in the US market, or it could work well in Hong Kong, or it could work well in Australia. How do we acquire an option in that business at a price that's reasonable today and have a 3 optionality? So if it does grow, we suddenly have something very valuable. And so we're in businesses from like platform businesses. So you could have davebet.com up and running in 10 minutes. It's like the Shopify betting. We're in lottery style businesses, we're in digital marketing businesses, we're in a voice betting solution where you can say the bet rather than text it or go to the website. All different types of tech that we think has the ability to significantly grow. Now that doesn't mean they all do, but when they do, we have something very valuable because we have the option. And if they don't, well, we haven't made huge capital outlay. We're buying them at fair value for the option price, but it's much less than having to put in a large equity check.
Got it.
Yeah.
Got it. Could be a potential, I guess, lesson for investors, you know, having the main portfolio that's ticking away, that is lower risk with filters, but at the same time, looking at an option strategy over, you know, in the listed space at the same time, couldn't it?
Yeah, look, for us, we found that in this space, it allowed us to really take a lot of bets or investments on a much wider array of businesses. With not much capital outlay, you know, and it made it very interesting for us. And we didn't start with the fund being where it's at now, and it's just that strategy worked, and now we've got funds under management. Well, we'd like to continue on the strategy that's working and deploy the money.
Let's talk performance. I think people are always keen to know how it's going. So maybe on the 13F fund and also the options fund.
Yeah, so the 13F fund we've been really happy with. So it's like lower P ratio and higher growth rate than the S&P. And we've outperformed the S&P for the last 3 or so years by 10.5%. And we're not looking to be, you know, the S&P is great. Do you know what I mean? We're very happy being in the S&P long term. And obviously in the future it might be, maybe we perform worse than the SP. You just
Sure.
don't know. But we're comfortable, and our investors are comfortable that this is a way to basically compound non-actively, you know, in terms of long-term investment in these companies. And then the option strategy has been great for us, you know, so the funds compounded over 80% per annum since we started. With 30-something times our investors' money. We've done really well because a few of these options have come off, you know, so we don't have options come off every few months, but we have had several over the last few years that have come off, and that really gives our significant outperformance over the US equity market when they do. And our aim, we feel that we've got a much more bigger team, and we really know where to focus, and we get a lot more inbound, and our network's a lot stronger than it was 5 or 6 years ago. So we feel we're in a much stronger position to do much better option deals and many more.
Sure.
But we look at 30 plus businesses a week. We did 7 option deals last year. We've done 4 so far this year. We've got 16 live option deals in the fund at the moment. But again, you can think that you've done an option deal with the best business of all time, and
it doesn't work out,
and it goes nowhere.
Yeah.
And then one business you're like, oh, I don't know, I think it's okay.
Yeah.
And it turns out to be amazing. You know, just that's the kind of, it's hard to, if I was, you wouldn't want me to pick which option deal is going to come off because I'm always on the wrong leg, you know?
Yeah, got it. I guess maybe stepping back a little bit now. So what I'm hearing is obviously, again, that IP and connections and network and constant work, on the option side. And then I guess a methodology that's, really repeatable and scalable on the 13F side. For the average investor, who looks at all that and goes, oh my gosh, that's complex. How could they think about maybe executing in their own way, in a simple way, using something like the Saxo platform, do you think?
Well, the families used the Saxo platform well before we started with the fund, and so we very happy to just passively allocate into the 13F strategy and park money in that strategy. And, and Saxo platform obviously makes it works well. Great relationship, obviously, that we've built over a period of time, and also very competitive on price. So there are 3 pretty good reasons that we like it. But we like that strategy because for us, it's in many ways set and forget. We go, well, look, those funds we want to be following, those positions we see as not ridiculous in terms of, I think our average PE ratio of our 13F strategy is 15.5 times.
Yeah, okay.
That's sort of in the long-term average of, so we're not going, we're going to this market ultra expensive, we're
nor ultra conservative.
Nor ultra conservative. And then, and then we just focus on the industry we know well, and I guess that's, I suppose, like other investors, they have their core business that they work day in, day out. That's where they make their money, and they passively invest, whether it's in stocks or properties or whatever their passive investment is. You want to have, many people have that combination, don't they?
They do. I think the missing, though, is as we keep coming back to having a methodology, and that's, I think, the key lesson I'm hearing here in this conversation. Other than that, I think I'm keen to know from your perspective, what's the number one takeaway, I think, in your journey, over the last, from, I guess, being on the track to being online to, William Hill to where you are today. What is sort of one of the 2 or 3 big key lessons, I think, during that journey, John, that you'd like to, Tom, that you'd like to impart with our, with our listeners?
Yeah, I think I remember when I was as a bookmaker, is that you didn't always have edge. And there are a lot of people most majority of people lose betting, but there's some people that win betting, and they win. They're very, very hard to beat, and they win a lot of money long term. And so you don't want to be going up against the big winners. You sort of want to follow them, and you want to be very disciplined to only play when you've got edge.
Got it.
And so for us, I sort of think now we want to follow long-term winners and really only play and be very active in the area we think we've got edge in. And that's sort of, and even when you think you've got edge, it doesn't mean you actually have edge,
Yes. But may or may not work out.
You may not.
But you're limiting your risk around
You're limiting your risk around the area that you feel really well. And that's very similar to bookmaking successfully, is that you've got to know your area of competence and really play where you have edge
in that
and
strong
be very
suit.
wary the other times.
Yeah, that's such a. I'm glad I asked that question. Look, Tom, thank you so much. We really appreciate it. I think one call out is, again, the relationship, but also how you've been always very forthright in the methodology, what you've learned. And it's such a great story. And I think the thing that strikes me also is adaptability, and having the foresight to look at what the future looks like. So, we really appreciate that. And we appreciate having the family as valued clients of Saxo. I guess for the listeners, there's a few lessons. The first is having a methodology that is scalable, replicable, and you can, I guess, continue to implement that, come, I guess, hell or high water is the first thing. The second I'm also hearing is where you do have that edge, just think about how you're expressing that, whether it be through a derivative or an option or something that's a little bit less capital intensive. And I guess the third, as you said before, is really, tapping into, where your area of competence is. So, Tom, thank you so much.
Thanks,
Thank you to the listeners, and we'll be back with our next event very, very soon. Thank you so much.